Good afternoon, everyone. My name is Art Alvarez with Mortgage Works, where we have the answers and they're on the house. Welcome to this week's Mortgage Minute, coming to you from Palm Springs in the greater Coachella Valley area. Almost sweater weather here. We're only at about 101. Was warmer than that earlier in the week, so a little bit of a cool-off phase, if you can call it that. And of course, tomorrow. What do we have tomorrow coming up? The dreaded Friday the 13th. Yes, a lot of folks get a little bit unsettled about that date. A couple things to note about it, though. You can be assured that in any given calendar year, there cannot be more than a max of 3 Friday the 13th during 13th. That's a tongue twister during the year. And if you want to plan ahead to work around those Fridays on the 13th, look at the calendar. Any month that starts on a Sunday, you will have a Friday the 13th in that month. So again, you can do some advanced planning and check out when the Friday the 13th is going to come up for the balance of this year. I think next year there's only going to be 2 Fridays that fall on the 13th. So again, you got plenty of time to work around that dreaded day and try to keep yourself safe and comfortable. With that, we'll go ahead and get into the mortgage and bond markets. Again, we'd like to start off the show with our rate grid right there on our homepage of our website. And good news, rates are a little bit better this week. We're now back to conforming 30-year fixed for a good credit score, decent down payment size, about 6.5. And that's with no points. The corresponding buydowns, 321 and 21 temporary buydowns, using that same 6.5 note rate. You can start at 3.5 on a 321 or 4.5 on a 21. We've got FHA broke through the 6% barrier. We're now at 5 7/8 for a 30-year fixed FHA, and then VA is at 6. So, and the other thing is that 15-year loan, 15-year fixed, has dropped down to 5 5/8, and again, those are all with no points. Even the jumbo loans are looking pretty good right now. 30-year fixed, 6 3/8. And then don't forget those equity loans. We've got some really hot deals, particularly on the HE loans. That's the fixed home equity loans. A 20-year term in particular, that's a sweet spot for pricing. Depending on, if you've got a good credit score, 780 or higher, and loan to value 60 or less, you can get a 20-year fixed rate second mortgage at 7.6, again with no points. So that's a hot deal. We've been doing a fair amount of those. So what's going on in terms of the bond market? Well, it's actually also pretty good news, which is why our rates today are a little bit better than they have been earlier in the week. And after last week, there, Jeff pulled up the chart. 10-year bond yield goes back to last Friday. And you can see early this week, it did climb a fair amount. In fact, we got over 450 during the week. We didn't see that Wednesday dip, but we're seeing it today. And so we're nicely down off the above 450 level down to 4.36. That's a pretty good number, and I think it looks like we're going to close the markets are closed at this point, so that should hold for the balance of the day, and we'll see what tomorrow brings. So in terms of that trend downward in bond yields, what is going on? What data points, what economic news is affecting where these bond yields are at? Well, this week, the primary data is 2 things: inflation and jobless claims. So inflation and jobs. And of course, earlier this week, we had the CPI come out. That's the consumer price index. That's inflation at a retail level. And again, like previous time, it came in lower than expected at 0.1% in May. It was forecast to be up 0.2%. And then the annual rate that's the year over year rate, 2.4, which is right on forecast. And remember, the Fed's target is 2. So we're not far off of that at all. In fact, inflation since January has only been up 1.4%. So the inflation numbers are continuing to be pretty positive, the right direction, what we want to see in terms of inflation. Inflation is much better than it was. So what this means in terms of the CPI, for sure, still no sign yet of any tariff-related spikes in inflation, in prices in general. So despite, again, we say beware the headlines, in spite of all the headlines about the tariffs are going to drastically increase inflation, prices are going to go up. So far, the data doesn't seem to show that. And we had more evidence of this today with the PPI, the Producer Price Index. Now that's the inflation number on a wholesale level. And once again, it was forecast to be at 0.2% in May. Now it came out today.
Hey, I'm just jumping in here real quick. It looks like we lost Art. He'll probably be back in. Something happened, but as he said, the forecast for the PPI, the forecast was 0.2% in May, and the core PPI forecast at 0.3% in May. And let's find out where Art went. There he is. He's coming back.
Oh yeah,
Art, we lost you there. Here we go.
we
Okay.
did.
All
So
right.
where do I pick up it from?
You can pick it up from the PPI report. I did my best, but you're the expert.
Okay, gotcha. Again, the PPI came out today. That's the Producer Price Index, inflation at a wholesale level. And again, it was forecast to be at 0.2% in May. It came in at 0.1% month, and that's a month-to-month number. So again, lower than forecast. And then the core PPI, which is the PPI excluding food and energy, it came in at 0.3% in May. So again, the PPI number along with the CPI number, inflation's looking pretty good. It's going in the right direction in terms of dropping. Then we had initial jobless claims. Those were forecast to be 246,000. It turns out it came in at 248,000, an 8-month high. But nonetheless, this is an indication that we haven't seen a dramatic increase in unemployment in higher jobless claims. Again, this is claims for unemployment benefits from people getting laid off. So this notion, all the headlines about tariffs affecting the jobs market, so far it doesn't look like that's happening. In fact, consider this: private sector jobs since first of the year up by 500,000. At the same time, and this gets into kind of the whole Doge thing, if you will, government jobs, that's federal government jobs, are down 59,000 since January. So when you look at those numbers, the job numbers are looking pretty good. We know from last week the unemployment rate stayed at 4.2%. That's very low historically. The inflation numbers, again, are looking very positive. So all the doom and gloom, all those headlines that we should always urge you to be aware of, so far haven't panned out in terms of the outcomes of Doge and tariffs, and it just hasn't really affected these data points, at least not yet. Now we could see what happens. That could change, but so far everything actually from the economy standpoint is looking pretty positive. So any of you worrying about that and fretting about that in terms of maybe not wanting to move forward and looking to purchase a home or refinance your home, I would urge you to rethink that, because overall the environment is looking pretty good economically. And in fact, the next big number that everyone is anticipating and can't wait to see is the second quarter GDP. The Atlanta Fed, they monitor the GDP from quarter to quarter, and they make predictions about what it's going to come out to be. Well, the Atlanta Fed, at least as of now, we're late in the quarter, they're projecting that second quarter GDP growth could be as much as 3.8%. That's very strong compared to the first quarter that was flat. So again, if that happens, we should all take a breather and calm down. In fact, in terms of worrying about the economy faltering, because so far the data just doesn't show it. So with that, we'll go ahead and bring Jeff in so we can do a little bit of discussion about the hidden risks of waiting to buy a home.
Hey, Art, how you doing?
Very good. How are you?
Good. Two things. First of all, you didn't mention anything about baseball, and you didn't talk about the fact that that's the French Open, the men's finals may have been one of the best matches ever played. What do you think?
I absolutely agree. I watched the whole thing. I mean, it was a 5.5 hour match, and I watch a lot of tennis. And historically, my guy was Rafael Nadal. Feel like a connection there, given my grandmother was from Spain. Mm-hmm. And so it was interesting to see Carlos. They were kind of think of him as Rafa Jr. I thought he was done after 2 sets. I mean, everybody did, right? Because he was down, 0-2 in terms of sets. It looked like center was going to breeze right through, and then boom, Carlos turned it around. And what was really for center, you got a feel for him. I mean, he he had, what was it, like 3 or 4 match points
Yeah.
in the fourth set, and Alvarez recovered from that and ended up winning the match. It was a terrific, one of the most impressive uh, uh, matches in the history of tennis, I think. So
I think it just shows, what you can do if you just hit one more shot. You just give it. It's a whole thing of like, I remember there was an example of in life. It says just get up and fight one more round. It may be the one that wins the match for you, and that was true. It seemed like it was a lot of fun to watch.
yeah, you got to keep moving forward. And as to baseball, real quick, my Angels. Yes, I'm sorry, I'm an Angel fan, and it makes me depressed half the time, but they're now tied for second place. They've been on a roll, so we still got hope. We'll see what happens.
Well, now here on a local level, I understand you did something kind of special with our Power Baseball.
Well, I was supposed to.
Oh,
I haven't had a chance to tell you. Yeah, on Tuesday night we do a Palm Springs Realtors does a realtor night at the Palm Springs Power baseball team. They're a kind of a amateur semi-pro team, and they play here every year. Terrific organization, and I was asked to throw out the first pitch because I've actually been nominated to be president-elect of the Greater Palm Springs Realtors for 2027. So I was there. I was ready to go. Had my Power baseball jersey on, and there was a mix-up with the folks that organized that part of the event. They had 3 other first pitches, including a little 6-month or 1-year or 2-year-old toddler, and somehow they forgot us on the list. And we brought it to their attention, and by the time we did, they said, "Sorry, too late. We're running out of time. The game's got to start." So I didn't get to throw the pitch.
Are they going to reschedule you
Next year?
Oh my goodness! Oh, that's tragic. Well, I was really looking forward to hearing about that.
I figured that was an excuse. I figured what really happened is the catcher for the team, I think he went to somebody and said he was too afraid of my 98-mile-an-hour heater. So I think he begged off because he was worried that I was just going to throw it too hard at him.
It was just a little too hot. Right? That has to be it. That has to be it. Yeah, absolutely. Well, today I want to talk about, there's a lot of things going on in the news. It's a buyer's market, people are waiting and things like that. And I really want to dig into this topic. Let me pull up today's screen and talk about this because, you've kind of alluded to this before, but it really is one of those things. Could waiting cost you thousands? And I have a few questions that I'm going to ask you about this, but, people are waiting on those sidelines. I saw something today. It was an article, and you'd mentioned it before about the number of people who basically pulled out of escrow, pulled out of their contracts, and thinking maybe they're going to wait for a lower price on the home because there's going to be this glut of homes, or we're going to see a 2008 situation, or the rates are going to go down. But gosh, the stuff you talked about today, and we've read about the economy, there's really not enough data on that. It's almost like somebody screaming in the back room and people making that a headline.
Exactly right. Yeah, there's the headlines, and then there's reality. There is a disconnect there, and what you're referring to, like pending home sales, there was a high percentage of pending home sales that canceled. And part of that was attributed to all this bad news about tariffs, et cetera, and the coming, hit to the economy, and people starting to worry, am I going to lose my job? And of course, what's happening in my 401k balance and my investment account balance and so forth. But again, the data doesn't support those headlines. So I think some of those decisions to hold off have proved to be maybe not the right thing in hindsight.
Well, I just want to ask you a question before we get into the bulk of our questions. Let's roll it back to 2008. And we did see one of those rare occasions where real estate lost value. But even if you had purchased a home in 2007 or the beginning of 2008, let's call it at the peak of the market, and then the home value dropped, does that mean the bank is going to call your note?
No.
Okay.
No, not at all. I mean, as long as even if the property is dropped in value to the point where the value is below your mortgage balance, no, I mean, the lender's not going to come after you, call the loan due, foreclose on you at all. As long as you're making the payments, you're fine. And, for some homeowners who did that and held out long enough, eventually their value recovered. And, by the late 2010s, 18, 19, certainly, home values had recovered fully from the '08 crash. The difference at that time um, was how mortgages were underwritten and approved. And we don't have an '08 situation now, meaning we don't have anywhere near the number of foreclosures we saw in '08. The reason we saw so many foreclosures in '08 was too many of the folks who bought homes, who are now owners, part of the housing stock, and then when they did see their values collapsing, and of course at that time there was a pretty good hit to the economy in general. People were losing their jobs, etc. Too many of those borrowers really could not afford the mortgages that they were given because we
Mm.
didn't adequately assess what is now called ATR, their ability to repay. All the stories about too many borrowers, too many homeowners bought homes with these no income verification, sometimes no asset verification loans. So they were given mortgages and therefore payments at levels that if we really peeled the onion and looked how much money they were making, look what their debts are, they would have never been approved for that loan because their debt to income ratio was not in line. So that's what contributed to so much of the collapse in housing prices after '08. So many of those people couldn't afford those homes and they walked away because they saw that their value was now underwater. So we don't
Mm.
have that now. The good thing about the current housing stock is most all of them have been fully qualified for the mortgages and the payments they're making. And so as a consequence, we have not seen this spike in delinquencies and a corresponding spike in foreclosures. It just hasn't happened.
So the exciting part about that is if somebody did buy a home in 2007, the value dropped, you didn't lose your home, the bank didn't call your note, and not only did you recover everything you lost, but you've also appreciated all the gain in equity since then, which is probably, I don't know, and it's state by state, locale by locale, but the change has been enormous, has it not?
Well, it has, as I said, by the late 2000 teens, again, 17, 18, 19, those who held on to their home after the '08 crash, their value had recovered. And of course, we all know what's happened to home values since, pre-pandemic, say 2019 to now. Well,
Mm.
those home values went up even more. So if you were fortunate enough to have bought before '08, even if you bought at the peak, 2005, 6, 7, um, if you were fortunate enough to hang on and you still own that home, you've recovered all of that loss from '08 and a whole bunch more. So it can pay to hold on and wait it out if the home otherwise suits your needs and it's a place that you want to continue to live in.
Well, let's talk about today's questions. The first one I have is, we're going to talk about what is the difference between a temporary and a permanent rate buy down, because the whole idea is as I said, this waiting could be costing you a lot of money. Actually, let me take that down. I'm a little advanced on that. I want to ask you, what are the hidden risks of waiting for lower interest rates and housing and possible housing crash?
Well, there's actually quite a few because there are risks in waiting. And if folks who have been waiting, I think, have already undertook or been, I would say, kind of affected by those risks. For example, if you're holding off, the risk is rising home prices. We've been talking about this for quite some time, that despite the big jump in rates a couple of years ago, rates more than doubled. Most in the public thought, well, this is going to lead to a drop in home prices because people can't afford homes, they're not going to buy those homes, therefore those prices are going to have to fall. That hasn't happened. So part of the risk of waiting for lower rates or this housing crash that never occurred is, in the meantime, home prices have gone up. And so, of course, as a consequence, during that time that you continue to wait, you're not building the equity that you could have been building if you had chose to purchase earlier. So that's the one big risk. The other thing is, how do you know when rates are going to drop and by how much? We don't know. I've reminded everybody that Fannie Mae, for example, they're forecasting still that conforming 30-year loans are going to be at 6.1 at the end of this year. That certainly doesn't suggest that we've got a big drop coming anytime soon. And to the extent that, sometimes the mortgage market rates can get kind of volatile, where you can see a dip briefly and then it goes back up. Anyone remember last September? The problem with that is that volatility sometimes can move very quickly. And as a consequence, you don't have an opportunity. if you're timing the market to grab that quick enough to take advantage of it. So that can be a risky thing too. The other thing is when rates do eventually drop, as a buyer, you're going to have a lot more competition from other buyers. That could make it harder for you to get an offer accepted. And then you all may start going back to the bidding wars where everyone's offering higher and higher over list price, and et cetera. So that's a risk that you're undertaking by having waited up until now and still wanting to wait until rates eventually do fall. Um, and while you're waiting, what happens if, again, the data doesn't support it now, there is a weakening in the economy? What happens? You could be faced with what we would call employment and qualification risk. What if something changes with your job? Maybe you get your hours cut back. Maybe you get laid off. It can affect your ability to qualify based on debt ratio. So you want to be careful of that as you wait, you could have something unforeseen happen in your employment income situation that in hindsight would have suggested you shouldn't have waited and you should have bought earlier. And again, the crash may not come anyway, even if rates do remain elevated, for a couple reasons. Housing inventory is still very, very tight. Plus the fact we still hear about those institutional buyers who buy up homes at the expense of the regular families who are trying to buy a place to live in. With those two factors still involved, that keeps the pressure on prices, certainly keeps them from falling, and I think has contributed to those prices going up. So again, those of you who have been waiting for those prices to fall, you've lost that opportunity to build equity. And at the time you do finally decide to start looking and maybe buy, you're going to be facing probably higher prices than you would have if you looked at something sooner. So that's another risk. And don't forget, inflation, again, is getting under control, but over time, inflation still erodes your buying power. So you have to consider that the longer you wait, the longer you wait. And even if inflation is relatively modest, as it's starting to be again, 2-3% a year or more, that erodes your purchasing power. So again, that's going to be a factor in terms of the price of the home the longer and longer you wait. So you have to consider all those risks. And because of those risks, that's why I suggest you're better to look at buying now, not later, if you're able to. And again, we can help you with that.
Well, the next question I have is, how do rising home prices and rents erode your buying power? Because I see these multifamily rental units going up, and then I am just blown away at what the rents are. Especially here in our area, there's one just not far from me in La Quinta that the rents for a 2-bedroom, 2-bath is $2,800 a month. And I'm thinking, oh my gosh, couldn't you buy a home for that? So I'm just curious about what your thoughts are on that.
Yeah, well, that's a very good question too. One of the things that people need to realize when you're waiting because you think rates are going to fall or home prices are going to fall, is the rate of increase in home prices may outpace your income increases. So waiting for that drop, if it doesn't happen, and it hasn't really happened yet, you could be faced with a situation that price of the home that you thought it would be at 2 years ago is now higher, and maybe your income hasn't risen in unison with that, so it's now become less affordable because you waited because your income didn't keep up with the increasing level of home prices. The other thing is, Jeff, as you mentioned, rents. Everyone forget. There's this argument that you're better off renting, the payments are lower. Yeah, relatively speaking, that's true in a fair amount of cases, but we've all heard about how rents are going up a lot, not just mortgage rates. Rents are going up a lot. And the problem with that is if you continue to stay on the sidelines waiting for lower rates, lower home prices, you're going to probably be faced with increasing rent payments. And the increasing rent payments is basically another risk factor, because what it does is it diminishes your ability to save up money for down payment and closing costs. So you want to keep that in mind. More higher and higher rent payments will drain your savings and keep you, prevent you from getting the amount of money that you need to accumulate in order to buy. Although I will also point out, folks, a lot of folks think that they need to accumulate more money to buy a home than you really need to. Check with us and we can give you a reality check as to whether or not you really do need to save up 10% or 15 or 20% of the home. In a lot of cases, that's not true, and we can help you determine if that's the case so that maybe you don't have to wait any longer. And the other thing is, again, by waiting, what's happening there is the home that you looked at or you thought you could get 2 years ago, 3 years ago. Now, with home prices continuing to go up, by waiting, what that may mean is you're going to end up having to buy less of a house than you thought you could buy 2 or 3 years ago, simply by function of the fact that you waited thinking the price was going to come down. It didn't. Thinking rates were going to come down. They haven't. And so as a consequence, you may end up, when you do decide to buy, you might not get quite the home that you thought you could buy because prices have gone up. And as a consequence, you may have to make some compromises in terms of the quality of the home and the size of the home and so forth, because you waited. And then, of course, the other missed opportunity is, again, the equity growth option. If you continue to rent, you're not building wealth at all. Hopefully, you're saving some money so you can buy a home. But again, higher rents diminish your ability to do that. And of course, by continuing to rent, none of that housing expenditure, none of that money you're spending to get a roof over your head is helping you in terms of building equity and therefore wealth at all. So you have to consider all those factors as to how higher home prices and higher rents can erode your ability to buy the home, and buy the home that you like at a price level and at a monthly cost that you can afford.
Well, one of the things that you point out, I think even as late as last week, you pointed out how people who are renters have that extra money that they may have spent or may have been able to save during the renting process are really spending it and never really getting an opportunity to say, okay, I've come up with my down payment. So they become these renters forever. With that, it seems like, hey, making the plunge and getting into buying a home is a way to, I hate to use the word force, but it's a forced savings account for you, is it not?
Well, of course it is. But just because you use the word forced savings, the connotation is that's a bad thing. Well, no, it's actually probably a good thing. I mean, I think sometimes folks need to be honest with themselves. And I'm not trying to be overly critical here, but sometimes you got to look in the mirror and tell yourself, what do you want in life? What are your priorities here? Do you want to build wealth? Yes, you have the necessity of having to put a roof over your head, but there's multiple ways to do that. Do you want to do that through renting, where you got no equity buildup at all because it's not an asset that you even own? You don't have the tax benefit of mortgage interest deduction. You say you're going to save up money so that you can buy a home later, but the reality is most of you don't do that. You end up spending the money that you're getting. And so as a consequence, you're not making any ground there. So I think you've just got to realize that you're better off trying to figure out a way to get in and buy now and not hold off any longer.
The other thing is, what's the impact of waiting on monthly payments, even if the rates drop later? And I can't help but bring up that example that you've had before, where someone was waiting to get that ideal rate for a certain reduction in their refinance, and they missed it entirely, where they could have, I think it was like 3 or 4 months, they could have saved $500 or $600 a month, and they ended up not saving at all.
Right. That's true. That's a good example of how waiting can hurt you. As it comes to purchasing a home, the problem is that if you're waiting, hoping the rates fall so that you're going to end up potentially having a lower monthly payment than which you could get today. Again, we're kind of repeating ourselves here, but the risk is, if the home price increases occur at a rate that's as fast or faster than the drop in rates, even with that drop in rates, because you waited, the price of the home may be that much more higher, to the point where taking advantage of that eventual lower rate may be almost all fully offset by the higher home price, which of course means higher loan amount. So you end up having to borrow a higher loan amount because the home price went up. And so even with the rate having dropped, that will mean that your overall outcome in terms of monthly payment may not be very much better than what it was if you had not waited and you bought earlier. So that's one thing to keep in mind. The other thing I always point out with this kind of question is, remember, you cannot refinance the purchase price, right? You may have thought, oh, I'm going to buy a home 2 years ago and they were costing $600,000, and then you decided that's too much, I think it's going to drop. Well, you wait 2 years, and at a 4 to 5% appreciation rate, guess what? That $600,000 house isn't 600 anymore. It's probably 650. And so if you decide to buy now, yeah, you've still got to get a mortgage and you got to get it at today's rates. But at least with the mortgage, you can refinance later when rates fall. But you cannot refinance that price. That home you could have bought for 600, if you buy now because you waited at 650, it is what it is. You can't roll back that increased value, that increased price that you're now going to have to confront. You've only got the opportunity to go ahead and buy at that price level, get the mortgage in place, complete the purchase, and then at least you have the refinance opportunity later. So that's the way I think about it in terms of how the waiting of better prices or better rates can affect your monthly payment, even if one or the other, well, not so much the home price, but even if rates fall, you could end up being disappointed in how much you can save.
Art, we're seeing just a little bit of an extra on this. We're seeing in some areas, and I just read this morning, so I'll use the Miami-Dade area. We're starting to see some home prices fall because we are seeing a rise in inventory and a reduction in buyers. What does that mean for that potential that they could have seen some reduction in price and then also, as you said, buy now, and then if the rates drop even further, they refinance in the future?
Yeah, well, yes, there are more indications in different markets that we're seeing enough increase in inventory and a little bit of a shift from a seller's market to a buyer's market. And so we are seeing some evidence in some markets, not overall, because again, overall home values continue to creep up. So this is more of a spot market situation, but nonetheless, in some markets, that higher inventory and the amount of buyer demand is such that home sellers are now faced with more competition in selling. There's more listings, and maybe being a little bit too optimistic at their initial list price, and then having to make some adjustment in that list price to generate more interest and get the home sold. That spells opportunity for those of you who've been waiting on the sidelines to buy. I think right now, and I know it sounds like a line, but it really isn't, the opportunity to extract some seller concessions is greater than it has been in quite some time. So you can use that as an opportunity. I'm hearing the traffic of prospective buyers is down a little bit, yet the amount of listings are up. For those of you waiting to buy, why not look at it now? You've got less competition as far as other buyers competing with you, and you've got a market that's shifted to where the buyers have a little bit more leverage. So that gives you the opportunity to get some seller dollars and use that towards your loan so that you can address your biggest concern is you don't like rates where they're at right now. Maybe you're kind of scraping your down payment and closing costs. You can use this current environment, some of these markets where there is some softening in the price, to get some concession, not in just a straight lower price. Get the concession in seller dollars, a seller credit. That way you can use that to apply to your loan to get a lower rate and potentially have enough other money left over from that credit to pay some or all of your closing costs. To the extent you can do both, lower your rate below market and cover all your closing costs, that's a big win for you. And you can do that even by offering full price, which of course helps the seller. But at the same time, if you're going to get a credit from them that's substantial, their net price is still a concession to you, the buyer, but you get that concession in a much more effective way on your loan.
Well, I think of a couple things. One is if somebody buys right now and they lock in whatever the rate is, that means their housing costs, what they're paying for that home outside of insurance, because that's fluctuating, and taxes, that's locked in.
Right.
And it's locked in for 30 years.
Right.
Right. So unlike if I am a renter, whether it's a home or a condo or an apartment, that owner of that property at any time can come back and say, hey, of course, there's contracts and there's lease agreements, but it can come back and say, we're going to raise your rent. You have no control over that. And some people have to do what? They have to move and they have to downsize. It seems like this is a way to just lock it in. I mean, as an example, we're adding solar, and the whole idea is because it will lock in my costs of electricity now for the next 20 years. While it might still escalate, which it is escalating, it locks it in. So I don't have to worry about the price anymore. Isn't that the same thing with a home?
Well, exactly right. In fact, that's the thing is like, and we've used this term before. It's gotten to be pretty well known in the certainly in the mortgage industry, financial markets in general, and it's that phrase of um, date the rate, marry the home.
Mm.
The idea here is, yes, if you bought the home already, you've locked in your price. Okay, the price of your home is not going to go up because you now own it. You paid the price. Again, unlike rent, where you are going to be exposed to rising rents potentially every year, at least to the extent the landlord can, depending on local rent control issues and so forth. But if you made the decision to already buy, you've locked in the price of your housing. It's not going to get worse. And yes, when you get that loan, you're going to get whatever the rate is. And of course, we keep encouraging people, as I just said, negotiate some concessions to apply that towards your loan rate. But even then, when you do that, you're only dating that rate, dating that loan structure. You've locked in your home price. That will never change because you're now the owner. But now keep dating that rate, at least in terms of what you initially obtained to buy the home. Then when rates do finally fall, guess what? You're going to stop dating that initial rate you got, and you're going to start dating a new rate after you refinance the mortgage.
Well, a perfect example for me is Forever, and you helped us out on this. Is we were at like 5.575 or something like that for our interest rate, and we were dating that rate, and we kept watching. And you said, "Hey, Jeff, the rate is I think it's 2.75," and we locked it in.
Right.
Now I've given that rate, I've given it a ring. So that was the coolest thing. So we got the relief of that, and I know I'm one of those people who said, "Hey, I'm not selling the house because we've got this great rate." But that's a perfect example, is it not?
It is a perfect example, and that's the whole point. Is that it's like we've talked before about Warren Buffett. He thinks the 30-year mortgage is the greatest thing since sliced bread, right? Um, and of course, his idea, his concept, his way of thinking about it is it's a one-sided bet. Again, so when you buy the home, you're locking in the price of the housing. When you get your initial loan, you're locking in the worst case on your rate. Yes, you may get some temporary or permanent buy down of that rate, but then the one-sided bet is you've locked in worst case on your mortgage or on your home price. You've locked in the worst case on your mortgage rate, but then you have that refinance opportunity when rates do finally fall. So there's your one-sided bet. You protected your worst case, and then all you have to look forward to is the upside when rates fall, and then you can take advantage of that.
Well, before we get to this next question, I want to ask you this question. Whenever in today's market, if I were to qualify for a home loan, are you betting on my future ability to pay or my current ability to pay?
Current, and that's a very important concept to understand. In fact, I just had this exact conversation with a prospective home buyer beginning of this week, and this was a prospective buyer I was pre-qualifying for a home builder, and she was tight in qualifying. We made good income, but she was very tight in qualifying for the home price level that she was interested in, and she was a little frustrated to hear that because she's in the medical field, nursing, and she's in a certificate program to kind of go the next level up in her nursing career, where apparently she's anticipating a significant increase in her compensation within the next 1 to 2 years.
Mm.
So in her mind, to hear that she was having trouble qualifying on debt ratio was puzzling and frustrating for her, because in her mind, she's thinking, well, wait a minute, within a very short time, I'm going to be able to easily afford that. And I had to explain to her that's not how it works. I like to tell folks that in the mortgage industry, a lender, or maybe more directly, their underwriting staff, they're historians. They're not futurists. And what I mean by that is they're going to make their underwriting decision not by what you say is going to happen in the future. Like, hey, look, I can handle this. Yeah, my debt ratio is 54%. It has to be under 50. But don't worry. In 9 months, when I finish my certificate program here, I'm going to have a 30% increase in my salary and I'll be fine. Well, I had to explain to this young lady that, yeah, that all sounds reasonable and logical. But I said to her, well, let me ask you a question. What happens if you don't finish your program? What happens if you don't finish it to completion and you get your certificate? That would mean that increase you're expecting isn't going to happen, right? She had to admit, well, yeah, you're right, that could happen. Well, the lender has to take that into account. They cannot make a loan based on you say you're going to earn this much more, 9 months from now. They make that loan and then that doesn't happen. And then the loan goes into default because you can't handle the payments like you thought you'd be able to. That's a problem. So
Mm.
they can't make the decision on that. It's got to be today's numbers, fully verified, and a calculation of your debt ratio. What happens in the future, they cannot take into account in almost all cases.
Well, I ask that, Art, because there are sometimes, and you probably run into this, obviously, in what you do, is when it's tight, and you tell us because you've run all the numbers that we can qualify, we can afford this mortgage. But in our world over here, we're saying, gosh, but we pay this much to go out to dinner, we do these kind of travel, we do this kind of extracurricular activity, and I'm not sure if I can afford it.
Well,
So does that mean we have to start saying, hey, we got to cut back a little bit?
well, I think so. I mean, that's the point. That's part of what we run into now is despite all the headlines, I run into quite a few people who are on the younger side of the age spectrum who actually are making pretty darn good money. I mean, I'm encountering folks like married couple and they're in their late 20s, and between the two of them, they're making $280,000 a year.
Mm.
And they often are the kind of folks where when we start talking about a pre-qualification and buying a home, and I give them the numbers, quite often I'll find myself in a situation where I'm saying, look, here's what you can qualify for. But of course, they've already told me, well, we want to stay at this level in terms of monthly payment. And so then I have to say, well, duly noted, but you know what? You may not realize this, you may not be comfortable with this, but I can qualify you for a payment that's, $800 a month higher. You're very well qualified for the payment you want. You can go much higher. But in a lot of cases, not all, in a lot of cases, they'll be surprised by that. But rather than say, oh, okay, then maybe I can buy a little nicer home. In some cases, they'll say, all right, understand, but we don't want that higher payment, even though you're telling me we can afford it. And usually, what's the reason for that? They don't want to make the compromises in their quality of life. It's the old, I don't want to be married to a payment. I want to be able to go on multiple vacations. I want to go out to eat nice restaurants, 3-4 times a week. I want to buy a very nice car. And yes, it's going to have a pretty hefty payment, et cetera, et cetera. Some folks don't want to make that compromise. And so they will have to settle for maybe a more modest home with a more modest mortgage amount because they don't want to make those hard choices and optimize or maximize the level of the price level of the home that they want to buy.
Well, I want to get into this last question, which is what smart strategies can buyers use today, even in a higher rate environment, to get ahead financially?
Well, we've already covered a couple of these strategies. One is, of course, remember always in the back of your mind, you're dating the rate, you're marrying the home. So you want to keep that in mind in a high rate environment. Don't hold off waiting for rates to fall. If we determine you can qualify at today's rates for the home price level that you're interested in, consider taking advantage of that, because in doing so, you're marrying the price of the home that is set, but you're dating the rate, so you're putting yourself in a position to refinance later. The other strategy is, as we also just touched on, negotiate seller concessions. And I urge people, don't just do it in the form of a lower price. Take what would have been that concession amount that would result from the lower price you were thinking, instead offer full price or nearly so, and ask for that same number of dollars concession as a seller credit. We can apply that directly to your loan and greatly improve the terms of your loan, including rate and monthly payment. The other thing to consider in terms of strategies in this environment is what we call house hacking, or buying a property where you can generate rental income from the property that you're buying. Most common example of that is, and we urge this to be a consideration, particularly for first-time home buyers, considering buying a multifamily unit property, a duplex, a triplex, a fourplex. There are some nice ones out there. Some folks, I think, have a connotation that those kind of properties are in neighborhoods with dominated by renters, and maybe the properties are not in that great a condition, neighborhoods not that great, et cetera. But no, there's some very nice 2, 3, 4 unit properties out there. Consider purchasing one. The benefit is you can use projected rental income from the other units for qualifying for the loan. And if you do that and you get those units occupied by tenants, you've got that income coming in to offset your monthly payment. So that's a big well, that's a good strategy to consider if you're looking for a way to buy now and get some help on your monthly mortgage expense. The other thing is consider looking for fixers. If you have the ability to do some handiwork yourself or to have access to people who can, buying a fixer upper or buying a fixer upper that might mean just really just what we call a cosmetically dated home, where the fixing up is generally just more cosmetic in nature. That could be a good way to get a home at a much more attractive price, a more affordable price, if you're willing to do the work to upgrade that home yourself, particularly if it's primarily cosmetic. And then overall, the biggest strategy advice I could give you is think long-term wealth building, not short-term on rates. You've got to think long-term about wealth building and realize that if we can help you determine that current rates are affordable to you, even though you feel uncomfortable about that, we can help you in terms of get those seller concessions, get that seller credit. We'll apply that to your loan, get your loan payment, your loan rate subsidized lower. And we could do that maybe for 2 to 3 years with these buy downs. And that gives you the opportunity for a refinance later. And then you'll be able to more affordably handle that mortgage and the home longer term. So all those strategies can help you in this current environment.
Art, I'm curious. It's like all things are equal. As an example, that old saying, "A bird in the hand is worth two in the bush," kind of thing. And I'm just curious, when you talk about a seller concession being more valuable than asking for a lower price, how does that work out?
Well, as mentioned before on the show, and I tell people all the time who want to buy a home, the requesting a seller concession in terms of a lower price offer below list, yes, it will help you lower your monthly payment on the mortgage portion of that, simply because your loan amount will be lower than if you offered full price. But you have to remember that is not that powerful in terms of lowering your monthly payment. If you have a home you're looking at that's 600,000 and you want to offer 570, that's $30,000. And you'll say, okay, well, at a 600,000 full price offer with 20% down, I'm going to have a payment of X amount per month. But if I offer 570 and they accept it, my 20% down will mean a lower loan amount by almost that 30,000. It's going to be more like 24,000. And that will lower your payment versus a full price offer, but not that much. I tell people each $1,000 borrowed is about $6 a month. So a $30,000 lower price means a $24,000 lower mortgage amount with 20% down. Well, 24,000 lower loan amount at $6 a month. Well, all that means is you're going to save maybe around $144 a month in your payment versus a full price offer. Whereas we can show people, offer full price, take that $30,000, ask for a seller credit. What we will do with that is show you how we can apply that to buy down your rate, either permanently for the whole 30-year term, or a temporary buy down off current note rates of 6.5, for example, like on our website, and get a 3-2-1 or a 2-1 temporary buy down. Well, for example, on the 3-2-1 on a $600,000 full price offer, you're not going to save $180 or $144 a month by getting that 30,000 seller concession as a credit. If we do a 3-2-1 buy down, that first year you're going to save over $1,000 a month. That's a whole lot better than 180. Now, in some cases, if you're having trouble qualifying on that structure because the note rate's too high, because remember, temporary buy downs are not used for qualifying at all. Your debt ratio is based on your note rate. In fact, I encountered a case earlier this week. The buyer wanted to do a current mortgage rate, note rate with a 3-2-1 buy down, but their income wasn't quite there to qualify in debt ratio at that note rate. What we did is we took that seller concession, which was substantial. In this case, it was $35,000. And what we did is we permanently bought down the rate into the low fives, like 5 3/8 from 6.5. And then we still had enough money left over from that seller concession to apply a 2-1 buy down on top of that. The benefit to that buyer was her debt ratio now was acceptable because it was off that note rate of 5 3/8, not 6.5. But then she still gets this 2-year subsidy in the rate and therefore payment. So she'll be at 3 3/8 the first year, 4 3/8 the second year, and then 5 3/8 for 28 years. Well, that first year at 3 3/8 saves her $750 a month over what it will be when it hits the note rate in year 3. So that's a very good example how we can help structure a financing package, a loan package, to take advantage of those seller concessions to optimize your monthly savings in the rate and the payment.
Art, that's amazing. $750 a month. I've never heard you talk about that where you said, okay, I did a permanent buy down, then there was enough money left over. We did another temporary buy down. That's pretty slick.
Yeah. Yeah. I mean, we don't do it all the time, but there are cases where it's needed because of a qualifying issue. Because again, a temporary buy down doesn't help people qualify at all in terms of your debt ratio. I think some consumers, I think wrongly, not intentionally, they just don't know, but they just think, well, gee, my first year rate's at 3.25. Why do I not qualify? Well, because your note rate might not be 3.25, it might be 6.25, and that's the rate we have to qualify you on. Again, it's that ability to repay concept that emerged out of the '08 crash created by the CFPB. We have to make sure, based on your current documented income, that you can afford to make the payments. And the whole purpose of that debt ratio calculation is to ensure that that's going to be the case.
Well, Art, this has been great. I think it's obvious now how waiting is not your best option. If you're thinking about buying a home, I put Art's information down below. You can call him. You can get him on his email, or you can call him at 760-969-5023. And let him help you understand, hey, can you afford to buy a home? Yes. Could you use one of these strategies? I love that whole idea of house hacking. That was a great idea.
Sure.
So, Art, thank you so much. I appreciate you taking the time today and really diving into these ideas. And again, for more information, get a hold of Art. Art, I'll turn it back to you. And maybe next year will come sooner, and you'll throw out that first pitch.
We'll see, Jeff. Thank you. Well, thank you, everyone, for watching and listening to this week's Mortgage Minute. Hope you have a great weekend. Of course, again, Friday the 13th is what the start of the weekend will be tomorrow. So hopefully you can tiptoe through that and be okay and get into the weekend and relax and enjoy yourself. So again, Art Alvarez at MortgageWorks, where we have the answers and they're on the house. I'll see you next week on the next edition of the Mortgage Minute. So long. Take care.